we're going to get started. This gentleman right here, I met this guy probably about 12 years ago.
No.
Was it? 8, 9, 10? So, okay. So probably about 9, 10 years ago, I bought a flip property. It was at Seabrook, right?
That's right.
And I don't even know how we met, but we got connected and he helped me with some long-term financing to refinance it was a property on Capri in Seabrook. Great freaking investment. I think in the back end, it netted like 60-something thousand dollars. It was a fantastic deal. And I've been working with this dude ever since. So he's funded dozens and dozens of deals for me and a bunch of people I know. If he's funded a deal for you, raise your hand. There you go. So if you don't know John Burns, you should really get to know him. The thing for me was, number one, he's easy to get a hold of. He's easy to communicate with. He's local. He shows up. He figures things out with you, right? Ask you questions. You ask him questions. You get it figured out. And not to pump up his head too much, but I think the guy's a damn genius. Like the way he thinks about money and maneuvers money is pretty fascinating. So when it came to being the bank and financing and all these things, I couldn't have thought of a better person to bring out here to talk to you guys. So if you don't have his number and his information, I hope this doesn't blow you up and drive you crazy too much, but if you don't have his information, you should get connected with this guy. Not just his available hard money, private money, but his network and his resources and all the stuff he knows about is very valuable. So it's the John Burns Show. You tell us, and I'm going to sit down and learn like everybody else.
I appreciate it. We have been working together a long time, and it's been a great relationship. He's introduced me to a lot of people, and I've always had a lot of respect for the way that Ozzie's ran his business. And so it's no surprise that he's got a room full of people here today. So a little bit about myself. You know, he talks about the way I look at money, and it's not really an accident. I'm a former bond trader from the Chicago Board of Trade. I had the good fortune of having a brother that worked down there when I was going to school. I went to Northwestern University in Evanston, which is essentially Chicago. I worked down there during the summers. And so I was able to go down there out of college. And so much of what we did in that world was really about managing risk. And we looked at things, or at least the people I was associated with, we looked at things as, you know, how do you manage losses? Because the winners will take care of themselves. Being a great trader is like being a great batter. You're only going to hit 33%, and you're going to be fabulously successful, right? So what does that mean? It means most of the time you're losing, right? So you have to manage those losses. And a lot of being the bank, right? One of the things I like about being the bank is that, you know, you can manage risk. And if you manage risk, right, you can control losses. And so that's why I added the whole Warren Buffett, right? Rule number 1, never lose money. Right? Rule number 2, don't forget rule number 1. Because when you're the private lender, when you're the bank, right, this is your money that you worked hard for. You don't want to just throw it out to anybody and put it into something where you don't know what kind of risk you're really taking on. And so that's kind of what we're going to talk about here today. So what does it mean to be the bank? It really means loaning money for the purpose of generating interest income over a specific period of time. It's just a generic definition, right? It's having your money work for you instead of working for money, right? Like your money's always working when it's out. It doesn't matter what's going on, right? It's safe, consistent returns. It's fixed income, right? If you're thinking of stocks and bonds, right? You know, what's a bond, right? It's fixed income. It's a loan. That's what being a private lender is. Except today, right? Think about what also is a bond, fixed income, or CDs, right? CDs, fixed income, right? Savings account, right? They give you a rate of return, right? Except the funny thing is that even though the Fed's raising interest rates like crazy, right? How many people's interest rates gone up on their savings account, right? Right? Not at all, right? It's barely budged. CD rates, they barely budge. So there are ways that you can take your hard-earned money and invest it essentially into fixed income, right? And earn a great return, right? Who can be a private lender? Anyone, all right? I mean, I hate to say if I can do it, you can do it. But the truth is, if I can do it, you can do it. Anybody can be a private lender. kind of a generic, private lender is defined as a lender that makes loans that are not affiliated with a bank, right? An individual or an entity, right? Hedge funds and institutional investors now market themselves as private lenders. Why, right? Well, private lenders fill the void that traditional banks don't get into in regards to a lot of investment properties. They don't like non-performing assets, right? They can't move at the speed that a regular investor wants to move it, right? Because y'all know when every fix and flip, when the closing date is, right? Mm-hmm. Yesterday, right? Next week, I need it done by tomorrow, right? And so there's no bank that is really going to work in those types of time frame. And so private lenders, they can work in gray areas, right? Where banks can't. And so we definitely fill a void. So anytime when the hedge funds, they came in after the mortgage crisis and they thought that they could buy houses and they could be successful landlords, right? What they ended up finding is that they could be a lot more successful actually loaning money to landlords, right? And so this is the space that they come in and they advertise themselves as being private lenders. Different ways to be a private lender. Short-term hard money loans. This is purchase and rehab. This is kind of bread and butter. Does everybody know what a hard money loan is?
Yes.
Right? 6 months, 9 months, a year, short term. It's going to have rehab component to it. Bridge loans, similar to hard money, just going to be longer term. Think land, multifamily, commercial, something like that. Landlord loans. Sorry. These are non-owner occupied term loans on income producing properties. This is really the space that hedge funds are going after. You might hear them called DSCR loans, things like that. The other thing is, so Ozzie wanted me to talk about IRAs. We are going to touch on some IRAs. These are the types of loans that I go for in my IRA account, right? Income producing property. Owner finance or seller finance loans. So you're purchasing a property with the intent of actually selling it. So essentially, this is a great way to build a note portfolio where you're buying a property at one price, you're selling it at another price, and you're carrying back the financing. And so even though your interest rate on your note might be, let's say 10%, your yield might be 15% because your dollars invested are down here. So it's like buying a note at a discount, but you just bought the property and sold it instead. And when you do that, you have a little bit more control over who you're lending the money to, because, well, you're actively involved in it. The other thing with owner financing is you need to make sure that you're Dodd-Frank compliant. Does anybody know what the Dodd-Frank regulations are?
You can only have up to 5 properties before you have to get your license, right? Or is it 6 now?
3.
It's 3?
It's 3. You can only do 3 in any 12 months. And then you have to use an RMLO, right? Now, I use an RMLO right up front. Doesn't matter because we want to make sure that we're always compliant with Dodd-Frank because the penalty for being wrong is very steep. It's like a $50,000 fine. You can owe as much as 3 years back payments to the borrower. And if you're wrong on one, they're not going to stop at one. They're going to crawl up in every deal that you did, and they're going to get you for everything. But I still really like owner finance, and we're going to go over an owner finance example later on. You can buy performing notes or loans. If you've ever gotten your own mortgage to your house, and then a month later, it says your loan's been sold, somebody bought it, right? Same concept. Private individuals can buy those notes. There's a secondary market for other people who do seller financing. They're now coming up with websites, PaperStack. There's I can't remember if it's PaperSource also, but they do have internet websites now where you can actually go and look for performing notes. You can buy a part of a loan, right? A partial. And then you can lend on an existing loan as collateral. A lot of small regional commercial banks, this is what they do, right? They will take your note as collateral and they will make a loan against it. And the terminology behind that is called hypothecation. Okay, it's a fancy term, but it just means to pledge. So, am I going too fast? Because I see you're.
Yeah, you don't want to. Right.
You need me to slow down or anything like that. I have a.
Does anybody have any questions about any of the terms we've gone over here so far? it's okay to have a question. If you don't know what hard money is, raise your hand.
Okay.
It's okay. All right, you good?
Okay, finding the money. This is what everybody really wants to know, right? Where can I get the money, right? So if you're lucky enough, you have personal funds, right? And you have enough money, you can loan just with your personal funds, right? You can HELOC, right? Home equity line of credit. You can refinance an investment property. You can use that as seed capital. There's a guy who ended up starting an institutional now lender here in the city of Houston. He literally started with a HELOC, right? And it wasn't his HELOC, it was his mom's. So he did okay on it, right? So you can take that money, you can form a partnership, right? Friends, family, JVs, right? LLC, you guys take your money, you pull it together. That way you can, make more loans, maybe make a loan, right? It just depends on how much you have. When I first started, going way back to 2011 when I started doing this, people were buying houses out of the Heights for like 50 grand. We're putting 35 in it. Whole loan would be under 100,000, right? Who knows what that house is worth today? Probably 3 million. I don't know. So the average size of the loan when I first started, I would say was probably, right around, it was probably under 100,000, right? That would be like the average deal that I was doing. Now that average size of that loan has creeped up. It's closer to 150 to 170, with a lot of them having the ARVs being in that 250 to 300 range, right? So it's definitely, as the market's appreciated, right, the amount of money you need has gone up, right? Now you can't start a fund. I'm not going to go into it. You're talking about securities at this point in time. It's federal, just go find an attorney and let them tell you, I'm not going to do it, right? There's all kinds of disclaimers around that stuff, but it is possible to actually do it. People have done it. It's not, all that information is out there. You can go and you can get it. You can get bank lines of credit. Again, this goes back to the hypothecation, right? They'll take your note receivable and they will lend against it, so you can go out and do more deals. And then retirement accounts, self-directed IRAs. There is a company here in Texas. How many people have heard of Quest Trust Company? Yeah. So you can take any IRA that you have and you can roll it over because they are a custodian. And so now you can have what's called a self-directed IRA account, right? So you're in control of it to an extent, right? So you have prohibitive transactions, right? A lot of stuff has to be arm's length transactions. I can't loan money to myself. I can't buy an asset of, where I personally benefit or like my direct lineage, right? But I can loan money to Ozzie through an IRA. As a matter of fact, when Ozzie talks about that term deal, that first one we did, that was out of an IRA account, right? So I like self-directed IRAs. I think they're great for lending money. I don't think they're great for owning property. We'll kind of get into that in another slide why. But it's fixed income, right? So you can have your stocks, you can have that in whatever account. But if you want fixed income where you're actually going to make some money, some real money, as opposed to 2%, right? You move it into a self-directed IRA account. You're going to loan that money out, and you're going to get a tax-free interest income coming in that's going to compound a hell of a lot faster than 2%, right? Pros and cons, right? So, I want to be fair about what it is and what it isn't, right? So, what it is a lot more passive, right? Who here is a landlord? Anybody? Right? Okay. So, your tenant floods the house, backs up the toilet, right? Who are they calling? They're calling you, right? Who are you calling then? Calling the plumber, right? If you own a home just outright and Bank of America is your lender, and your kid backs up their toilet, are you calling Bank of America? Hell no, right? Hell no. So it's passive, right? So once you do the due diligence on the front end, the returns are a lot more passive, right? Risk reward. In my opinion, this is just my opinion, right? This is the most bang for your buck. I kind of joke, there's some people in the room that keep telling me they want to get in my position. I keep telling them they're going to have to take a pay cut, right? But at the end of the day, there's a little bit of truth to it, right? Because flippers are making big money, right? But they're also taking big risks. They have to pay the lender, right? They got to put their money out with the contractor, right? They always have a certain amount in float. As soon as you start opening up walls, you don't know what you're going to find, right? The market can shift suddenly. The Fed can raise interest rates up to, God knows what, right? And all of that is going to affect their return, right? But at the end of the day, when you're the lender, right, what have you done? You've removed a lot of that risk, right? But when you do that, you don't make as much money, but you still make enough of a return that, in my opinion, right, it's the most bang for your buck, right? Your money's always working. You can do it from anywhere. Any vacation I've taken, I've lent money while I'm on vacation. They're all working vacations. Why? Because all I need is a laptop and an internet connection, right? And I can do a deal. And so a lot of times I'll take a couple hour out a day in the morning, a couple hours in the evening, everyone's got cell phones, right? You can go, let me go off to the side, hang on, let me look through this. Yep, okay, we're good to go. Let's go, let's fund. And then I'm back on my vacation, right? And so that part is great, right? It's definitely less volatile than the stock market, right? When I have my note portfolio, I don't care what the stock market's doing, right? I really don't. It's pretty volatile right now. And heaven forbid you're ever in a situation where you need to pull money from the stock market and it's going down, because these days when it goes down, it's like somebody yells fire, right? And everybody runs for the exit. And if you're in that exit trying to get out, like, you're screwed, right? I traded in a day. So y'all know the pitch, right? You ever been on CNBC, see the people in the crazy coats and they're standing there, you're yelling, they got their hands, right? Like, that's literally what I did, right? And so this was the days before the electronic market really came in. Now they just push buttons, right? They just push buttons and the market just goes. And so that's how you see these big swings that you would never see before. So when they hit sell, like when whatever, that's it. Like it goes. On the con side, you don't get to participate in any price appreciation, right? So I know plenty of people in this room that have benefited greatly from price appreciation, and I got nothing, right? And it's not totally true. I got my interest payments, right? But that's okay, right? It's good for them. It's good for me. But you don't participate, right? Interest income is ordinary income, right? That's one of the reasons why I think using a self-directed IRA is so important, because rather than pay the ordinary income on it, it goes tax-free into your retirement account. I'm a firm believer that if you own property, you should own property in your personal name or an entity that flows through to you personally, because now you really have the depreciation, right? So, I own rent houses, I'm so-so on rent houses. I like them. I love depreciation and I love appreciation, right? I don't really like tenants. Just being honest. You do need to understand federal regulations. You do need to understand Dodd-Frank. You need to understand everything down to even servicing your loans, right? Who can service them, especially when you're dealing with owner occupants as opposed to non-owner occupants, right? And then foreclosures, they're just more expensive and they take longer than eviction, right? Evictions are taking longer in Houston, right? They did pass that law post-COVID where they give people, the judge has the ability to abate it and say, we can, kick this out, 60 days and see if they can't work something out before you go back to the eviction, right? But with the foreclosure, right, first of all, you can't even foreclose on an owner occupant until they've been delinquent for 120 days. That's 4 months, right? How many people think they file bankruptcy before the 120 days gets there? They all do it, right? They do it like the week before, right? Because they know they go to attorneys, right? So then they file bankruptcy. So last foreclosure I had for an owner occupant went 9 months before I got paid. 9 months. Now, I got made whole, right? But I had an underlying loan at that entire time that I had to keep current. So for 9 months, I made payments on a loan that I couldn't collect on. And I finally got everything. And to make matters worse, they put the house on the market and they made a bunch of money. And I was like, you gotta be kidding me. But that's just how it works sometimes. Loan parameters. All right, if you all want to take a picture of this slide. All right, because this is your box. This is how you manage. This is where managing risk starts. Okay, you need to have an idea of what it is that you want to do and how you're going to do it before you just go out there and say, hey, I'm a money store and I'm open for business. Because people will come to you with everything under the sun, right? I've been asked to lend on hotels, warehouses, vacant land, gas stations, right? You name it. And then they'll come to me and they'll say, hey, I'll give you X, right? Oh, I'm going to give you X% of the return. If you just, we got to close, like I need the money like tomorrow, right? They will try and get you out of your box, right? Because they want what's good for them, right? Not necessarily what's good for you, right? And then you got to stay away from these magic words, okay? I should have put it in my keys to success, but just these magic words you got to stay away from, okay? You ready? Mm-hmm. You can't lose. Right? Anybody who says you can't lose, just run. Okay? Just get out of here, right? It's not even, like, they clearly never lent money, right? But seriously, this is your box, right? This is where the risk control starts. What kind of asset do you want to loan money on? Are you comfortable loaning money on mobile home? Are you comfortable loaning money on land, right? Are you comfortable loaning money on a commercial like property, right? Or you just want to do single family, right? Location, are you going to do it local? Are you going to do it out of state? You're going to do it in state. Texas is huge, right? Personally, I've loaned money in Houston and San Antonio, right? And somebody asked me about Dallas. I was like, I don't know, that's too far. I don't know anybody in Dallas. Like that's outside of where I want to feel comfortable, right? Lean position, right? That's another one. You can do first, you can do second. Anybody here want to do a third? Anybody? No? That's good, because I was going to tell you, if you did, just cut me a check for half and call it a victory, right? Loan to value and investment to value. All right, how much are you going to lend on a property? How much of the value are you willing to lend on? Investment to value is really when you're buying a note, right? It's kind of the same thing, right? But it's already, loan to value is when you're the lender. Investment to value is when you're buying a note, right? So how much of your money are you putting into what the value of that property actually is, right? Are you going to have escrows? How long do you want the loan for, right? All of these things, you hear people talk about loan programs and things like that. Well, what is it, right? These are your loan parameters. This is how you're mitigating risk by not doing certain deals. Ozzie's talking about right over here. He's just asked me, we got a deal. He's talking about building the ground construction, new construction, right? Well, new construction is not something I do, right? I just never got into it.
Except for this one time.
Except for I never got into it, but I have my box, I have my parameters, right? I don't necessarily, need to step out of it, except for Ozzie. So anyway, does anybody have any questions about this? Anything about loan terms, loan parameters? You guys know what yield is? The difference between interest rate and yield?
What is yield?
What is yield? So yield is the difference. So like interest rate is like the face value of what the note is, right? So the note can be at 5%, 10%, 12%, doesn't matter. Your yield is what your return is based on the amount of money that you have invested in it, right? So I gave you a scenario earlier. So we buy a property here, right? You do owner financing, you sell it like here, right? Well, I have this in a slide. I did that loan at 9.99%, okay? That's the interest rate of that note. My yield is more like 16% because of the dollars I have invested, right? Does that make sense? Everybody understand that?
I have a question. So what type of loan terms do you like, or is there certain loan terms that you like to do when you do this?
Yes.
What is that?
So I like a mix.
Okay.
I look at it more like I have a note portfolio. The bulk of what I do is mostly short term, right? It's still like your hard money loans. And on those, basically they're a year. I set them up as 9 months and then with like a 3-month extension. And quite honestly, the people that I deal with that when they're doing fix and flips, I want to make sure that they have enough time to do the deal. But I don't necessarily feel the need to beat them over the head like some of the institutions where, you know, they want 6 months and then they charge another point for 3 months and another point for 3 months, things like that, right? But typically on fix and flips, I do like to see people move them out at the end of the year because I shouldn't be the one making all the money, right? And if they're in that deal for a year, it's too long. I also have a fair amount of landlord loans. Then those are 5-year terms, right? And so I got, you know, this kind of middle rate. And then I have some owner financing notes where it's anything from 15 to 30 years, right?
Those landlord just interest only.
Nope, those are amortized, right? That would actually go under payment terms, right? So you want to do your payment terms, is like you want interest only or do you want principal and interest, right? So on the short-term hard money loans, those are interest only. Bridge loans, those would be interest only, right? So it's short-term. They're getting into it for a specific reason to either rehab it or it's the bridge between purchasing it and their long-term financing, right? But if I'm going to hold a rent house, an income-producing property, then we want principal reduction.
So are you working a 30 or 20-year amortization? And then what's your standard on your balloons?
5 years.
Okay, so 20-year.
Well, so like I just did, and we'll get to it. I have the example. I did a mobile home on land, and I just did a straight 20-year term, right? And I'm comfortable with it, right? So I like cash flow, right? So that's hard money loans are great. 12%. Okay, that sounds like a great number. I'm sure to everybody in this room, if you're earning 12% on your money, you'd be happy, right? I'm happy. But guess what? You only earn that 12% when that money's out, right? If that money's not out, you're not earning 12%, right? And so the truth of the matter is that loans typically turn about 5 months, right? That's about the average, right? People who are doing fix and flips, things like that. I know everybody likes to think they're going to turn them fast. Michael turns them fast. He holds the record. But you know, most of the time it's gonna be about 5 months, right? So if you say that, you know, what's your money working 10 months out of the year, right? That's assuming that as soon as you get that money back, right, that you can get it right back out the door, and that's actually pretty hard to do, right? So it's so it doesn't always work out that way. And so I like the medium term because then that's just constant cash flow, right? It's just coming in every month. And then the longer term, same thing. And so it's like, you know, in the investment world, people would call it a bond ladder. I don't know, maybe you've heard that term, maybe not, but essentially that's what it is. But the bulk is short term. But it's honestly, it's whatever you want, right? It's
You have a mix.
yeah, you can do what you want, right? So anybody else? No? Okay.
I don't know if you're gonna go into, are you gonna go into a standard like hard money loan, rehab draws and all that?
I wasn't planning on it. I mean, I certainly can if you guys, so I'm gonna open it up for questions at some point in time. If you guys really want to get into that, I mean, I can, you know,
The only reason
tell you, I have rehab draws on here. Yeah, so that's a good question.
to touch on it, because a lot of people don't realize this. You can get a hard money loan. Well, they'll loan you the $100,000 to buy it at closing. Then they'll put the $50,000 of rehab in an escrow holdover, as long as the numbers work and it fits in the right LTV. They'll put that $50,000 in an escrow account. And as you make your rehab, you're gonna put in a draw request and you can start getting your money back. So they'll actually fund the whole thing from purchase to rehab.
So like on my hard money loans, I want to fund 100% of the rehab, right? I want to make sure that that portion is always going to be there, because even though I trust a lot of the borrowers I work with, you work with some people you just don't know, right? You don't know what their level of experience, things like that. But at the end of the day, if you're just looking at this from just a straight risk perspective in managing risk, right? I want to make sure that my LTV is going to maintain where I want it to be. And the only way I can do that is by controlling the rehab fund, right? And so we dole it out on a draw request. So they have to submit, it's just a spreadsheet or a form saying, hey, look, this much of the work is done. And then we go and we inspect it and we give them the money for the work that's actually completed, right? And so, and another thing I would say about that, and I know some lenders, unsophisticated, I would call them lenders, they give the borrower the money up front, right? And it's like, if you're a flipper, would you ever give your contractor the money up front? Hell no, right? No offense to any of the borrowers that I have in the room, they're not getting the money up front. It's just not going to happen, right? Because you just don't know what's going to happen at that point in time. And heaven forbid something does happen, where's your loan to value now, right? Because you put the money out, but now that property still has to be fixed. And if you already gave that money away and now you got to come out on top of that, you're going to be underwater. I guarantee it. Does that help, Ozzie?
Yes.
Does that help?
Yes.
Okay. Underwriting. This is the other big part of the due diligence, right? So from an underwriting perspective, I can break this down real easy, okay? You got your borrower on one hand, you got your asset on the other hand, right? The stronger the borrower, more flexibility you have based on the asset, right? Strong borrower, strong property, great, love it. Strong borrower, weak property, I can get that done based on the borrower's strengths, right? Do you have a weak borrower and a weak property? No, that's not going to work, right? Most of the time it's usually, in here. But to kind of simplify it, that's what you're really looking at, right? You're really looking at the numbers, right? From an asset perspective, how good is the property? How much money is it producing, right? How deep of a discount did they buy it based on what the rehab budget is to what the value is, right? On the borrower side, how much cash reserves do they have, right? How much experience do they have, right? Does credit matter, right? And the answer is yes, credit always matters, right? The credit is a cycle, and so where are they in the cycle? And everybody has different challenges that they've been through in life and different things like that. It's really understanding where someone is right now, right? But, I know when I first got into real estate, people would say stuff like, no credit, no cash, no credit, no problem, right? You can find a deal. Well, you better have one hell of a deal if you got no money and you got no credit in order to get that to somebody who's going to take that out, right? And so, but in a nutshell, that's what it is. It's kind of playing that game between how good is the property, how good is the borrower. The better the borrower, the more flexibility you have on property, right? What I mean by big property, slim margins, right? Not so good of an area, right? Major rehab, borrower with not much experience, right? Something like that, right? That's things that are going to affect, like, I don't know. DSCR, debt service coverage ratio. You guys know what debt service coverage ratio is, right? How much income's coming in the door for how much debt you have, right? So, like, for every $1 of debt that you have, what's your income, right? A lot of commercial banks like to see 1.25. Hedge funds on the landlord loans like to see at least 1.15, right? DTI is what, like, if you're an owner occupant, they call debt to income, right? How much debt to income? With the property, it's DSCR, right? That's really, it does help if you have construction background, if you're going to do a hard money loan. It really does, if you know what you're looking at, right? Because then you can look at somebody's scope of work and see if it's appropriate for the property, right? I'm always a big fan of putting your eyes on the property. If I don't personally put my eyes on the property, I make sure that I send somebody out to that property so that they can see it and that we have a file. That way we can also verify what work has actually been done, that they said that they did the work that they set out to do, right? And so what that means, if you put in, whatever certain bathroom upgrades or something like that, we're going in and we're literally cross-checking what it was before, what it is now against the REIT scope of work and making sure that it's done as you said it was, right? Flood zone, right? That's something that's kind of important down here, right? You should know if your property's in a flood zone, right? Anybody flood during Harvey? Yeah. I had some, I had a deal at the time over here, Orange Street. Yeah. Luckily it didn't flood, but they didn't have flood insurance. And yeah, I was a little nervous on that one. Any questions about underwriting?
Well, I had a question. So if someone comes to you with a deal, but they don't have any contract work experience or any contractors, but they have a good property, good area, good, numbers and stuff, what do you do in that
Bring the
situation?
deal to me.
Honestly, the real answer is you need a general contractor, right? And you need cash reserves,
Okay.
right? And that's really what it comes to. And if you don't have the cash reserves, you take the deal, Ozzie.
I'll be both.
But that's the real answer, right?
Yeah.
As a matter of fact, somebody called me today before I came over here, and this is a guy who he likes to partner with people, right? He said, "Hey, I want to bring you this guy, but here's the thing: he doesn't have a job right now. He got into real estate. He said he's done a couple of deals, but he doesn't have W-2 income, but he's got cash, right? And he told me how much cash he has. Is this going to be a problem, right? Will you approve him, right?" And I was like, well, first of all, I've had good dealings with this guy. So I said, I'm just going to make the assumption that you're going to bring me somebody who is, that he is what you say he is, right? I'm going to verify, right? But then will I approve him? It's like, well, that's a little bit more difficult because it really depends on what the property is that you bring now, right? Because depending on how much money you have in cash reserves, is it appropriate for the deal that you're bringing me, right? If you're bringing me, if you got 50 grand in cash, right? And you're bringing $1 million deal, right? And the rehab budget's 200,000. Well, that's easy, right? But if you got 50 grand and you're bringing a deal that is 200,000 and the rehab is 50,000, right? Yeah, you got enough money, right? You got enough money to have it float to cover the carrying cost, to get the contractor started, and to carry it for a number of months before you run out of money. It'll sell before you run out of money. Does that make sense?
Yeah.
Right. So it's a balance. It's a balance, right? It's more art than science.
Yeah.
From that perspective, right? But that is one of the things I do. Like anybody that I've lent money to, like one of the first things I say is show me the money, right? I need bank statements, right? Because I need to know that there's something there. Right? Because if there's not, that's how you're going to run into problems. And I have foreclosed on people, and it's not fun, right? It is not fun. I don't want to get properties back, right? I know people say, oh, well, but you could come out ahead. Well, that's not really how it works, because technically speaking, legally speaking, any overage goes back to the previous owners. I don't get to keep any of it unless I take it REO where nobody bids on it at auction, and then I have to sell it. But if nobody bids on it at auction, there's no overage, right? I'm not making anything. I'm only losing, right? Does that make sense? Okay. Funding and post-closing, I added this because it is a real thing. It is part of the process of lending. You need to know loan docs and assignments. You need to know, depending on what kind of deal you're doing, you need to know what kind of paperwork you're dealing with, right? You need to know if you're dealing with loan, deed of trust, right? Assignment of rents, or if you're buying a note, you're doing an assignment and a lodge, right? A lodge is just an endorsement of payments over to whoever buys it, right? You'd be amazed at how many people, including title agents, think I but there's plenty of title agents that will screw up a closing statement, right? And you need to know how to read title report, right? These are all things that you should learn. Document storage, okay? Right? Even though everything in this world seems to be going digital, okay, I can promise you that notes is not. There's so much paper involved in it, physical paper, that you constantly have to deal with. The document storage is actually a real thing. And the note, the original note, is the value. So, if it's in a fire and you lose it, it doesn't mean the lien goes away, but you can't use it as it's no longer an asset, so to speak, that you can use at that point in time. Any questions? Loan servicing. Oh, that's the other thing I want to say. Loan servicing. This is your collections, right? This is your collections. How are you going to collect your money, right? I use third-party loan servicers, right? They're licensed debt collectors. They have a website, telephone. They're not all perfect. As a matter of fact, each one of them that I use, it's 3 of them, each one of them has something I hate about them. You know, unless I could just combine them, right? That would be best, right? But that can't be done. But you do need to, servicing loans, everyone thinks they can get into it. If you're doing one that you can service a loan, I went and bought software at one point in time trying to service my own loans. It's not easy, right? It sucks, if I'm being honest. So, life cycle of a loan, okay? When I say anybody can do this, anybody can do this because this is the life cycle of a loan. It's not overly complicated, right? It don't have a fancy acronym like BRRRR, you know, buy, rehab, rinse, repeat, but it's still very much a cycle. Deal sourcing, underwriting, funding and closing, loan servicing, payoff and release, right? It doesn't matter if you're going to do 1 deal, 2 deals in a year, or you're going to do 100. It follows the same cycle, right? The guys that are real busy are going to always be sourcing deals. There's always going to be deals in underwriting, right? I always have deals in underwriting. We're always having deals in funding and closing, right? Loan servicing, it's collections. It's always ongoing, right? And then there's payoffs and releases, and we just keep going round and round and round, right? Because you go round and round so much, it's also why I like some of the longer term deals, right? Because, you know, I didn't want to get too much into the pros and cons of each individual strategy, but one of the cons against hard money is it's a hustle, right? You have to work for that deal flow. It doesn't just happen magically, right? You have to build relationships. You have to get to know people. You have to network. You have to find them. And I say no a lot, right? There's lots of deals I don't do, right? So there's constant sourcing, constant. So that's why I like to have some of that longer term, some of those longer term notes because it's more the passive cash, right? Does that make sense?
And I tell you, with John, I trust him so much that there's been deals that I could have bought without him, but when he looked at it and said, this is too risky, I walked away. Because he knows the stuff, he understands risk. And that's a really big deal. You gotta understand what the risk is in the situation. Sometimes you're gonna have to lose 2, 3, 5. I lost $10,000 out of this money before. Sometimes you just gotta be willing to walk away from it. Because losing 30,000 is a lot worse than losing 10,000.
So, question, how you guys underwriting this? Are you guys also asking for like ARV appraisals?
Absolutely. Absolutely. Surveys. So if we go back, underwriting. So the way I actually operate is I call it like top-down approach, right? So when I deal with the borrower, I'm going to do an underwriting on them one time, right? I'm going to pull their credit, right? I actually pull background checks, okay? So
You still lend to me?
that's right. But when it comes to determining value, absolutely I do appraisals. I do surveys, right? I want to know. I want to know what, in the off chance that there is an issue, right? It may help, it may not. I don't know. Right? Flood certs, right? I got a bank that I work with. They pull the flood certificates for me, right? So if it comes back, it's in a flood zone, we kick it back to the borrowers. Say, look, it's in a flood zone, you got to have flood insurance, right? I do want to see a scope of work. If somebody, I don't mind if somebody acts as a GC if they've got the experience, right? I don't mind, but I need to see what you're doing in writing, right? And then you have to follow through with what you're doing in writing. So you know, not everybody has to use a general contractor. Certain people do. Certain people are the general contractor, right? And that's fine, right? That's fine. But I do look at the scope of work, and we do send it out to the appraiser so they can actually get an apples to apples comparison. Because, right, you don't want my landlord house with laminate countertops and stock cabinets, you know, compared to, you know, a house that has, you know, custom cabinets, brand new, like top of the line appliances, granite, quartz countertops, things like that. So you want to make sure that you're getting as close a comparison as possible, right, to other properties so that you can get the most value, right? And what I always tell people, especially on a hard money or rehab situation, is, throw it all in at first, right? Because we can always cut back at that point in time. So you're better off if you can get it done in the financing up front and get it done, because you don't want to then go back in and pay for it out of pocket, right? And be like, oh, I should have changed that. Well, now the financing is set. We can't make that change. Now you got to pay for it out of pocket, right? But if we build it into the budget up front, now it's a part of the financing. It's less money out of pocket for the borrower, right? Make sense?
Mm-hmm.
Okay, so you asked about value. Is there anything else on the underwriting aspect of it? No?
Are those loan servicings pretty expensive? Are they pretty reasonable, those companies?
Depends on who you ask.
Okay.
Borrowers will say yes, I would say no. And some of them are, but it's, straight interest only is about $20 a month, and escrows are about $35. Right, that's about the best deals that I've seen. There's one company out there that'll do it for less, but you get what you pay for.
Okay.
Right. So, so that's it. But yeah, so that's how we do value. That's it. I guess I'm moving on. Any questions about the life cycle of a loan? All right, 'cause it is basic. I don't mean to but even if, so I will say this, even if you're somebody who's just looking to do a passive deal, you just want a retirement account, something like that, and you just want to do, you just have enough money for one deal, right? Maybe two, right? You still have to source that deal, right? You still have to find another lender, an operator, right? Somebody who's doing it that you can actually work with. If you're going to buy a performing note, you still have to go out and actively find that. From an underwriting perspective, what you're really looking for is you're looking for somebody, I call it a collateral file, right? If you buy it on if you buy a note from somebody, they'll call it a tape, right? Which is a fancy word for a line item Excel spreadsheet, that just goes across with all the information in it. But it just gives you certain pieces of information, doesn't give you everything. I like a collateral file better because a collateral file is going to have everything. It's going to have the insurance certificates. It's going to have, in my collateral file, you'll find a flood certificate, you'll find a survey, you'll find an appraisal, right? You'll find a title commitment, you'll find a closing letter of protection, right? And what you really want is the scope of work will be in there, right? What you really want is you want somebody to have that file, put it in front of you, where now you can do your due diligence yourself, right? Because what's that say about the operator at that point in time, right? You want to be able to have it kind of done for you in that perspective, and then you go on to funding and closing. And once you get over to here, right, a good operator will already have the loan servicing set up and will handle the payoff and release. So now it truly becomes a passive deal for yourself. Does that make sense, right? So there's a way to do it, but you still have to go through these steps, right? It doesn't just appear, right? You still have to, I love Quest Trust Company, okay? Quest puts on all kinds of events like this where you can network with people and you can find, people that are doing all different kinds of things. They'll let people get up there and pitch their deals, right? And they will pitch everything, right? Hotels, you name it. But at the end of the day, that's still deal sourcing, right? And then you would have to underwrite that deal to a certain extent. So you'd still have to put some effort into this. There's no such thing as not putting any effort in. And if you don't put any effort in, right, then what do you think you're going to get, right? You're either going to get nothing or you're going to lose, right? And I'll just give you an example of a deal that literally I'm going through this right now. So about a month ago, this guy calls me up out of the blue. I have no idea who he is, right? He leaves me this voicemail. It's kind of weird, right? And then all of a sudden I get from a borrower that's agitating me, more because of her performance, right? And that's another thing I didn't talk about from an underwriting standpoint. Paying attention to borrowers' payment history will tell you a lot about where they are from a liquidity standpoint. But this particular lady, she's behind, right? And this guy calls me up. He says, "I want to know what the payoff is." I said, "Man, I don't even know who you are." "Well, I'm so-and-so's private money partner." I said, "I don't know what you're talking about," right? As far as I know, I did the deal with this lady. She signed on the dotted line. This is all I know. So I call her up. I start talking. Well, yeah, she admits she's got a private money deal, right? She got off on the side. As it turns out, this guy has no money. I'm sorry, he has nothing in writing. Nothing in writing. There's no joint venture agreement. There's nothing, right? He's not involved in the entity because she did it through an entity, right? He doesn't know what the rehab budget is. He doesn't know how much she spent on the rehab, right? All he knows is that she keeps coming back and asking him for money, okay? And she's in default, right? So I said, you got a problem, and
Partying on Facebook, though.
I was here at Quest events. And Quest had this big expo, right? And I was there, and I walked up to her, and of course she was so nervous, right? She was so nervous, and she's like shaking. And I said, you better find somebody in this room that can take me out of that loan, right? I said, there's plenty of lenders and there's plenty of private money in here. I said, so you need to be working, right? I feel bad for this guy, but I mean, what is he thinking, right? And he calls himself like an investor. Oh yeah, no, I'm a private lender. I'm whatever. I'm doing this. I'm doing that. So I don't know what the hell you're doing, but you're staring down the barrel of 100% loss, right? And as a matter of fact, that's one of my texts. I said, look, man, I said you need to figure it out with her because come Monday, I'm filing a letter of demand. Right, so you guys need to figure it out because you're about to lose everything. So come Monday, I got paid. We're not out of the woods on that one because it's at the maturity date and I'm not extending it. So I told him I said I need 10% down for me to even think about it. Otherwise, you need to get this thing moved now, right? And I hate it like that, but at the end of the day, her payment history is what I'm looking at, right? I need her to be gone. She mismanaged this project. I'm not going to work with her again, right? So, underwriting sometimes is also going with your gut after dealing with people, right? I'm not going to deal with her. So now we're going to go over some examples of where I actually did bring in passive lenders, where we kind of structured win-win deals. And we're going to go over one that's like my favorite way to lend out of an IRA. Okay, and these are real deals. Okay, so this one is a bridge loan. It's multifamily, 8 units out of Pasadena, Texas. It appraised for $590,000. This deal is a couple years old because you cannot find an 8-unit building in Pasadena for $590,000 unless it's 100% vacant, right? So the investor, he got the deal and he had the cash to actually do the full rehab. He wanted to put the property on the market and see what he could sell it for first. And if it wasn't going to sell for a certain price, then he was going to go in and do the rehab, right? So we did a bridge loan. It was a $360,000 loan, 12% interest, right? It's 1% a month, so I'm making $3,600 a month. We did a 2-year balloon, right? So we've got interest only, 24 months on this deal, right? So we do this deal. About a week later, I get a phone call. Hey, I need money. I got to close next week. Okay. I'm pretty sure it was Ozzie.
Was it me? What deal was it?
I'm teasing, man.
The storage.
So, but I didn't get a deal. Like the investor did come to me. They wanted I needed money essentially to fund the next deal. Right. And so then I turned to some passive investors I've worked with in the past. And I said, hey, start making phone calls. I need money, right? I got this deal, blah, 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 right? So I found somebody, they put up $300,000. We negotiated 10% interest. It's $2,500 a month. Because it was so quick, because we hadn't even made a monthly payment yet, they just stepped in and they were willing to go the full distance of 24 months, right? So their investment to value is essentially 50%. It's a little bit over, but I just 50%, right? Because they put up $300,000 on a $590,000 property, right? Is this investor happy? Yeah, he's loving it, right? 10% passive. He didn't do anything for it, right? Except put his money in the deal. He's got a margin of safety on an income producing property, right? He's happy, right? I still got skin in the game. I got $60,000 residual. I'm earning a spread between 10 and 12%. So it's $1,100 a month, and I still got a 2-year balloon on this thing, right? Am I happy?
Yes.
Yeah.
Yes. Would I have liked to get the guy down maybe 8%? Sure. Right. But am I happy? Yeah. Right. I am, because I was able to take that $300,000. I was able to go out. I was able to fund a whole nother deal. Right. And what do you think my yield is on the $60,000 that I've got? Right. So the face value of the note's 12%. I got $60,000 invested. I'm making $1,100 a month. My yield is 22%. Okay. Am I happy? Damn right I'm happy. Right. So any questions about this type of structure, this type of deal? Really? Nothing?
Yeah, well, y'all are confused.
Well, I have a question. When you first started doing this, what was your first deal like? Because these are like probably bigger numbers for me. But like, how did you, like, when you did your first one, how did that go?
Like, I was very scared.
Yeah. But like, how much did you loan out or?
I honestly can't remember. But a lot of deals back then were under $100,000.
That's right, you did say that.
Yeah,
You
a lot
did
of
say
deals
that,
were
never
under
mind.
100,000.
You did say
Yeah,
that.
I'll tell you how I got involved in it. Like, we'll get through this, but
Okay.
I'll tell you how I stumbled into it. I literally stumbled into it,
Okay,
right? And I just ran with it. So
yeah, now that's a good turnaround. I think.
yeah, no, this was a great deal. Actually, the really disappointing thing about this deal is that they actually found the buyer and it closed out in like 3 months, right? That was the most disappointing thing.
So if you would have got him, I'm not really, I don't know much about this stuff, so
It's okay.
I might be a ridiculous question, but if you had gotten him down to like 8%, would you have tried to consider getting him to put all of it up? So that, because you still have that, a large amount that you're making on the percentage, it would
Yeah.
have been more advantageous for you to not put any money up at that point.
Well, yeah, I mean, I would have loved to like not hit anything in it
Okay.
because I still would have gotten the difference.
You're 4%.
I still would have gotten the 2%.
I'm saying if you got him down to like 8 or 7.
Well, yeah,
that-
I mean, obviously, I'd make more money.
But
right.
what I'm saying is, would that have made you not put your money in? Is there a reason you put the 60 in, or is it just that you could only get 300?
I could only get 300,
Okay, that's what.
right? Because it is a larger dollar amount. And not everybody has $300,000 laying around that they can just say, yeah, hey, let's go, right? You know, I put this in because I think it was just a good illustration of how a deal could be structured, right? That it's where, and we did an assignment and a launch. We had payment terms structured. We both signed it, so it was like it was a formalized agreement. It was an investor that I've worked with quite a bit, and so he was looking for 10%, and he had the cash. Right, he was one of the first calls I made because I knew he had like a certain amount of money. I was looking for all 360. I wanted to get all of my cash out to go put in other deals. I took what I could get at the time. Right, it was more important for me to go and make the other loans, right, to deal with the people that I was dealing with, to make sure that they got funded. And so I wasn't disappointed. I was still earning a yield of 22%, right? When I'm in it for all cash, I'm earning 12%, right? So it's not bad. It's a win-win, right? It really was, right? Like I said, the only thing that really sucked about it was that it paid off in 3 months.
Well, it seems like that's the best situation, is to be making money off of the interest of somebody else's money. Being in the, I mean.
That's what banks do, man.
Yeah.
That's what banks do. Technically, like your deposit accounts at a bank, right? It's fractionalized lending. They can lend off of it. That's the real reason that right now the CD, like not CD savings, well, the CDs aren't going up. And the reason that like interest savings accounts, they're not going up, because what's the Fed really doing, right? So it's like a two-pronged approach. They're raising interest rates and they're doing quantitative tightening. So they're taking money out of the system. So banks are loaning less, right? So they have enough fractionalized lending of your cash sitting in the bank that they don't need to raise rates to raise money on CDs, right? But what are they doing? They might jack up a CD. We're running a special. We'll pay 5%, right? Well, they're going to pay you 5%. They're going to turn around. They're going to loan that money out for what? Something more, right? Something more. right? And so, yeah, absolutely. I mean, well, here, let's just move on to the next one. I'll show you the next one, because it's a deal where there's a spread, right? And I'm always trying to work spread. And even when I'm working with banks, right? Because I work with banks as well, where everything that I'm doing is about managing a spread, right? Now, I mean, I'm several years into this, right? I'm 10 plus years into this, right? But you also have to understand, I'm also coming from a risk management background, right? And so I'm looking at the spread. I remember having a conversation with Michael. He said, aren't you worried about doing this when they're raising rates? And I was like, well, of course I'm terrified, right? But at the end of the day, you know, I'm managing a spread, right? And so if I manage that spread accordingly, I'll always be fine, right? On this particular deal, so this is a mobile home on a third of an acre. This is in Humboldt, Texas. I just did this deal, right? This is very recent. This is not the mobile homes of old that you're thinking about. This mobile home is nice, right? Had this little shed right here. They had this little air condition. They built it out like, you know, the guy used it as like a workshop. He had like some weights in there and stuff like that. But it was very well maintained. I sold this with owner financing. Sold it for $165,000. We took a 10% down payment, so the note was $148,500. So 20-year amortization. 9.99 is the actual rate on the note. Excuse me, on the note. But I'm gonna go ahead and just say 10%. It's Dodd-Frank compliant. Okay. What that means is that we had a third-party RMLO underwrite and do the due diligence on the borrower, right? So what we did is we bought the property. The people were nice enough to clean it on the way out. So we didn't even have to bring in a cleaning crew. We held an open house and we had a showing. We found our buyer. We collected about 6 or 7 applications. We kind of went through them. We gathered all the paperwork, sent it off to the RMLO. RMLO did his underwriting on it, but at that point in time, I already knew it was going to pass because I just knew what they were looking for. That's why we pre-screened the people, right? And so at the end of the day, the RMLO that we use, they actually give a certificate that says ability to repay has been met. This loan is now Dodd-Frank compliant, right? So that in the event that, let's say something bad happens to the borrower down the road, right? And they're like, oh, he tried to screw me, whatever, right? We can show that we followed all of the rules and that they did meet all of the requirements so that we're protected, right? So at the end of the day, what Dodd-Frank really is trying to do is trying to keep people from being predatory lenders. A predatory lender is defined as essentially loaning money to people when you know that they can't repay it, right? And if you do that, you're deemed to be predatory. Well, I don't want to be deemed as predatory, right? I really don't. Because at the end of the day, the guy, the family that bought this trailer, they loved it, right? This was a great opportunity for them. They had money, right? They had saved money. They had mattress money, right? They had a good job, right? It's the husband had a good job. And he might have been I-10. I can't remember, right? But at the end of the day, we can still work with I-10, right? And mobile homes are hard to finance. And so secondary financing on the reason, right? If you buy a new mobile home, it's easy to get financing. But on the secondary, like once it's been resold, it's actually hard to get financing. So this was actually a great opportunity for these people. And like I said, we collected like 6 or 7 applications just in 2 days, right? So people wanted this property, right? And then we have third-party loan servicer. It's actually required when you do owner-occupied deals. You have to be a licensed debt collector, right? You cannot service an owner-occupied note as an individual. So the note terms, 148, 20 years, 9.99, it's 1432. That's what the note face value of the note collected, right? So we have a passive investor who's investing $110,000 at 8% on a 15-year amortization, right? So they're collecting a little bit over $1,000 a month. The debt service coverage ratio on this is 1.36, which means that for every dollar of debt we have $1.36 coming in, right? So there's plenty of income coming in to cover this, right? And their investment to value is 66%, right? This investor's happy, right? They're happy with this kind of, right? I still have $38,500 in the deal. I'm collecting the spread between 8 and 10%, which is $380 a month, and I'm recapitalized to buy another deal, right? So I'm happy, right? And if anybody owns rent houses, right, what you'll know is that this 380 is coming to me, right? I might make the same thing on a rent house before repairs, before they move out, then I gotta go in and paint it, right? But when I do owner financing, that 380 is just cash flow to me. And on top of that, we have a differential between the amortizations of 5 years, which means that I'm paying down that note faster than what's being paid down to me. So just like with the rent house, we talk about somebody else is paying my mortgage, right? Somebody else is paying my mortgage, right? Same thing, we just structured it with a note, right? So this is powerful stuff right here. I do love owner financing. It can be tricky though.
So, did you say, are those fixed or those aren't?
These are fixed. These are fixed. This guy's an arm. We can do that.
So what you're saying is I could, as an investor, I can find a property, I can list it, terms, and then I can market it as owner finance, find the buyer, screen them, send them to you.
No. I'm too expensive. If you go back to, if we go back to this deal, like life cycle of a loan, right? So you find the property, you deal source it, right? You're gonna have an added step in here because you're actually taking physical possession of the property, right? So you may or may not do rehab or something like that. So that would be an added step, right? The RMLO does the underwriting right here, right? But on these particular deals, I'm not providing the underlying financing on these, right? As a hard money lender, right? I always tell people you cannot wrap my loan, right? You cannot do it. That's what it would be called, wrap it, right? Right. So if you buy it, you have a loan, then you wrap it, right? You cannot wrap my hard money loans. If you wrap one of my hard money loans, I'm gonna file, right? I have no choice. It's my financing, right? My financing, right? You who has the money makes the rules, right? Well, I'm dealing on my hard money, I deal with like a lot of bank lines, right? So they tell me they can't wrap it. You can't wrap it, right? As a individual, if you go out and you buy a property, right? That's the trick with owner financing, right? That's the trick. You either have to have a private investor lined up, you either have to have the cash, you have to have a private investor lined up where you can actually, they'll pay for it essentially, and then you sell it and you wrap it, right? And that's a different strategy that I'm not really getting into the fine details of that. In this particular case, because then you have other noticing too. So you have to give like a debt disclosure at that point in time. I've actually lost deals at the closing table, right? Where you hand somebody, and we give them all this information beforehand, but you know, people don't really read or they don't have computers on their phone, so they don't really know what it is, right? You say, look, there's a debt disclosure. They get at the closing table and say, oh my God, what is this? Well, they have debt on the property. What does that mean? Well, it means if they don't pay, right, then you know, they can get foreclosed on. And then I lose my house? Kinda, right? No, I'm not signing this, right? And they walk away, right? So what we did is we paid cash. We did the deal. We don't have, there's no debt disclosure, right? I'm not wrapping it. What I'm doing is I'm pledging that as collateral, right? I'm hypothecating it, right? We talked about it in the beginning, hypothecate, sign it, right? So, and when I do that, the person who comes in underneath, now I can set those loan terms how I want. And this is ultimately the property is the collateral within the note, right? So if you went and you bought a property, you got to figure out how you're going to pay for it up front, right? Cash, loan from somebody that will let you wrap it, right? And then hard money, I would say, you know, I wouldn't do hard money because, you know, I wouldn't do it. Even if you had a private investor that's hard money, that's an interest-only loan, it's real easy to get upside down on that, right? That's another reason we have 20 and 15, right? When I say upside down on that, right, what I mean is what happens if this borrower starts paying it down faster, right? What happens if that borrower starts paying down that note faster than I'm paying down my note, right? Well, I don't ever want to find myself where, you know, as it stands right now, they owe me more than I owe, right? But if I find myself in this type of a position, that's not good, right? That's not good. Because what happens if they pay that off? Now I got to come out of, now I have to pay off this underlying loan, right? I don't have a choice. So then you have to come out of pocket. So what we do whenever and trailers are notorious for this, right? They'll get $5,000, they'll get a tax refund check, they'll do something, man, they'll just put it right on that mortgage, right? They'll pay it down quick, right? This won't go 20 years. This will go 5. They'll have it paid off, right? And in that period of time, right, any big chunks that come in, then I'll pay those down, right? I have to, right? It's a discipline thing for me because I don't ever want to find myself up there, right? But if you go find a house and you find a borrower and you have all that, right, you wouldn't take that underlying note. Like you would need to, we have to find somewhere to I call it lay it off, right? You have to find somewhere to you know, put your spread on. But it's not going to be me because I want to be this guy, right? I don't want to be that guy. No offense.
This might be a question to them, but so the note terms, say I purchase a home, bought it, rehobbed it, I know you can stop there, but I can stop at the note terms and not bring any investor and any lender. Like I am the one who, like, say someone comes to my house, I want to owner finance this, you pay me $1,400 a month, that's straight to me, right? Is that what possible?
Well,
Would possible, but
how did you buy the house to begin with? Do you own it free and clear?
yeah, I've
Okay, so if you own it free and clear, yeah, you can sell it with owner financing, and then this would come. This would so in all actuality, right? Even if I didn't bring in a private lender, right? So the 1432 that's coming in for me, right? Even though it's a 9.99% loan, my yield is close to 16% on this. Yeah, that's my yield. That's my real rate of return based on the dollars that I had in, right? I could live with the 16% return. I just don't want to, right? Because I want to recapitalize and I want to go buy another one, right? And I'm happy making the spread, right? And I'm happy making the spread, right? Does that make sense? Right? Yes, no? Yeah, okay, we're good. Okay. Any other questions on this?
I mean, yeah, because I mean, if I go down the street and I have cash, or if I want to owner finance, like I'm the purchaser of someone who's selling an owner finance, I need to know most of this.
If you're buying a house, from somebody who's doing owner financing,
Yes.
okay, then the loan terms, right, you are now the consumer,
Yes.
right? The biggest thing that you need to be aware of, right, is one, that well, maybe as the consumer, you don't want them to use Dodd-Frank.
Yeah, so that's probably there's.
But the thing you really want to know is if they have debt underneath the property. That's what you want to know. You can't stop them from pledging it as collateral. But if they have debt on the property at the time of purchase, that's what you really need to know. Because, again, if they don't make that payment, you're technically at risk. Now, it would take a while to actually get there. There would be a process. They'd have to foreclose on the first, right? Because you would technically be considered a second, right? And then if you didn't make a payment, then that's how they would foreclose on you, because they would take that note receivable as collateral. But then they're not in the business of owning those types of notes, depending on the bank. So they would want somehow to get you off their books, right? If that makes any sense.
Or accelerate the loan.
If they can. If there's a balloon or something like that, if there's an arm, something like that. Owner finance, that's what I want to say about owner finance. I love owner finance, right? I do. But you gotta be careful when you enter that space, right? There's a lot that goes into it. I could spend an entire hour and a half just talking about owner financing. I could spend an hour and a half talking about hard money. All right, so this is the last example I have. This is actually one of my rent houses. It's up in Crosby. I love this house. It's a great house. Appraised value is $236,000. The income and expenses are listed here. The $1,600 is what the insurance was. The $5,900 is the 2022 taxes. They shot up 30%. This deal was a lot better 6 months ago. It's not as much now. No HOA and it's not in the flood zone, okay? This is the DSCR type loan, right? Debt service coverage loan, right? My wife and I talk about this. We go, man, should we really own this property? Should we keep it? Should we sell it? And I'll get into why in a moment when I show you the next slide. But I keep it because I still like depreciation. I still like appreciation, right? The one thing I have to do is I have to raise rent, right? Guy's lease isn't up yet, but I have to raise rent because it just, the cash flow is going in the wrong direction because I don't even have my new insurance yet. That number's going to change. I'm not going to be happy when I get it. Hedge funds, this is what they do, right? And this is, so you know, if I'm going to get a little personal, my father-in-law passed away recently. And so, you know, one thing that he did is he did leave my mother-in-law in a very good position, right? A lot of that money's in IRA. So when we knew that he was getting sick and he was going downhill, and this was about a year-long process, right? I started taking the best deals that came to me that were like this, and I put them in my mother-in-law's account. And I did that because, you know, they have required minimum distributions, right? So we want interest coming in where the principal is not at risk. And this is as safe as that I can do, right? So I don't know what else to say about it other than that's how much I believe in these types of loans, right? So on this one, we ended up with a $130,000 loan, 7.5%, 30-year amortization with a 5-year balloon. The LTV on this one is 55%, right? So loan to value to the investor is 55%. So there's a huge margin of safety here. Okay, the debt coverage ratio is 1.17, is low. Okay, it barely, you know, barely meets the 1.15 minimum, right? Monthly financials now look like this: $1,795, and the income insurance is $134, taxes $492, debt service is $909. My net income is $260. $260 before any repairs. Tenants moving out. What do you think's gonna happen when I tell a tenant rent's going up $150? Is he gonna move or is he gonna stay? I don't know, right? But then I'm gonna have to go and paint the house, right? Clean it. It's gonna cost me all of this over the course of a year. So when we talk about owner financing, where I'm making $380 versus $260, right? Even if I raise it $100 a month, I'm still not where I was on the owner finance deal, right? But I still love these loans. I still love to be the lender, and I'm okay being the buyer as well. Like I said, I think that owning rental properties has its place in everyone's portfolio, right? Just as I think loaning money has its place in everyone's portfolio as well, right? So any questions on this type of deal? I must be doing a great job of explaining this.
And I know
Is that everyone's
some
just
of you guys-
glazed over,
like,
right?
to be honest, I know some of us are like, what the hell is he talking about? This is a
It's
strange
okay.
kind of different type of math here. But this is all recorded, so we're gonna have it in a place where I can go back and look at it, kind of slow down the slides, break it
Yeah, and I
down
don't know
for
how
yourself,
fast I'm talking.
and get a little bit deeper
You're
into the
doing
math.
great, yeah.
And this, it's complicated, guys. When you move into the lender space, it's different. I mean, we worked deals where we bought a storage facility and I had a first lien holder position was you.
Me.
Second lien holder was owner finance.
Yeah,
I
did that
cashed out
twice.
quicker than Mike did. We got cashed out like,
Yeah, that's
I
another
sold-
one.
I sold part of the land off real quick
Yeah,
and then we
paid
ended
me
up.
off in no
Did you-
time.
Did you buy the note? From
I did. I ended
like
up
a
buying.
9%,
Yeah,
10%
I ended up.
discount?
Yeah,
He bought the note on the back end. I picked up a 5% on the back end, note 2 on the owner finance. It's
Yeah.
super, it could be really complicated.
and it paid. That note paid off. Like
It
he was
paid
able to pay that off so fast that like I cut him. Like we cut a deal on the back end as well. So I mean, there's all kinds. It's creative finance is what it is, right? And you know, the more you understand about financing. So I look at properties like this. So we never talked about how I actually got into this, but I came when I left being a trader. So I was a bond trader, like 2000 to like 2010, right? I started off. I was an ARB clerk. Anybody heard of long-term capital management? When Genius failed, right? Hedge fund went down. We're talking a Russian ruble, higher currency default, 1997. I'm showing my age, right? Right? So my first day as an ARB clerk, right, was like limit down in the bond pit. And I'm like, I mean, it was chaos. I'd never seen anything like so chaotic in my entire life, right? I mean, it was, I don't even know how to explain what it was, other than guys yelling, people getting in fights, like, you know, just markets flying all over the place, right? After doing that for so many years, I was done. I was burnt out, right? In the early days, we would do like they would do. So every 3 months, there's a calendar roll in bonds, right? I traded 10-year Treasury note. We had 30-year bonds, 10-year Treasury notes, 5 years, 2 years, Fed funds, right? Where they're raising interest rates, Fed funds, right? It's all traded on the floor of the Chicago Board of Trade. I was in the 10 years. We do the calendar roll. I slept, these are early days where you had to plug in the little thing so you get Wi-Fi, you know, and it was real big, you know, and you plug it into your computer. And I'd sleep with this next to my bed because we'd have these positions on. And we wait for the ding. So like, I never really slept, right? You just kind of have, you hear ding, 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 you get up and start trading, right? You know? And the truth of the matter is it was such like it was actually a terrible lifestyle. Hours were fantastic. Not gonna lie about that. Hours, bell rang at 7:20, literally the bell rang at 7:20 and it went till 2 o'clock in the afternoon. Okay. So the hours were fantastic. But I would stand in one place on a busy day from 7 to 2 and I would never even leave. Wouldn't even go to the bathroom, nothing. You just stand there and you just trade, right? You can only do that so many years like that. And then like the attitude was, I mean, we were so backwards, right? You'd never take a vacation because you'd lose too much money that you weren't making when you were gone, right? And then if you weren't making any money, you could never take a vacation because you had to be there because you never knew when you were going to make money again, right? So it's like you just like, you know, you just can't just hamster wheel, right? You know? So eventually I wanted to get out of it, right? And there was actually a trigger for me that got me to get out of it, and I did. And I looked at it like a trader. I looked at what was cheap. Where can I get, you know, where can I get value? Where can I find value? And it was actually, it was in real estate, right? Because this is like 2010. Stuff had already come down, so I got to buy, you know, got to buy houses. At that point in time, my wife was pregnant with our second set of twins. I have 2 sets of twins.
Oh my goodness, wow.
And she no longer wanted to work. And so we looked at, my in-laws were living in the Houston area at the time. So why don't you look at Houston? So we started looking at real estate in Houston where the ratio was really high back then, right? Because the prices were low and you could get good rents. And so we moved here. So I moved here, I started buying houses and I tried to go get a loan. Banks laughed at me. Let's get out of here, right? I got no job. I've been self-employed my entire life. So, you know, I have no W-2 income. My wife wasn't working. You can't get a, you know, we were not going to loan you any money. And I just went to bank until I found a banker who looked at what I had and he said, you should be the bank. I said, what do you mean? He said, well, you know, you could loan your money out and you would be better off, right? Stop buying rent houses, right? Just start loaning your money, get your cash, right? And like he said, this is how you're going to work your way into being bankable. I didn't really know what he meant, right? Found an attorney, right? And the attorney was kind enough. He said, well, if you take me out to lunch, right? He's like, I'll give you free advice while we're at lunch. And I took this guy out to lunch like 3 times a week, every week. You know, I went to all these investor groups. I'd take like all the institutional hard money. Back then, everything was still paper, right? Even though it's 2010, right? 2011, right? They'd have their application on paper. I'd take it, you know, and I'd just look at what their loan terms were. And I started looking at it, but it resonated with me, right? Risk management, right? Loan to value, right? Looking at it's a bond at that point in time. It made sense to me, right? And so that's literally how I got into it. And it's just kind of grown from there, right? And everybody has a why. And keys to success. We're going to go over keys to success first. Sorry, thought I was done. Take the time to put together loan parameters and a due diligence process. Okay, that's a must, right? You really do need to do that because if you don't do it, then you're letting other people dictate to you what you're doing with your money, right? the golden rule, he who has the money makes the rules, so to speak, right? Obviously, you gotta be competitive and market rates and blah, blah, blah. But at the end of the day, don't let somebody else dictate to you, right? Or get you out of your comfort zone. Because some people, not everybody, all they want is to get their deal done. They don't care about you, right? Don't do those deals, right? Trust but verify, right? Seems simple, but man, like I said, you would never give a contractor all of the money up front, right? You'll give your borrowers all the money up front. Trust but verify, right? Build relationships. I cannot emphasize this enough, right? The reason I'm here is because of the relationship I have with Ozzie, right? And the reason some of these other people are here that I loan money to in the room is because of the relationship I have with Ozzie and the relationship I built with them, right? I've been doing this over 10 years. I don't have a business card and I don't have a website. It's all word of mouth. It's all people I meet, networking, right? It's all relationships. So that's my opinion. It's worked for me. Maintain a vendors list. Okay, you will need a vendors list. What kind of vendors do you have in lending? Right? Loan servicers, appraisers, attorneys, title agents, right? All people that you need, right? You need agents, just regular real estate agents. Hey, I need you to check out this deal for me. I need you to run comps. I need you to, right? These last two kind of go together. You got to stay disciplined. Trading was all about discipline. Lending is all about discipline, right? Know thyself. Stay away from deals that you do not feel comfortable with. Okay, I can't say that enough, right? If listen to your gut, right? It's there for a reason, right? If you're not comfortable, don't do it. I've seen too many people get into deals, right? They're freaking out and they just want out, right? And I've come in plenty of times and taken out other lenders because there's nothing wrong with the deal. They're just not comfortable, right? They're just not comfortable, right? If you're not comfortable, don't do it, right? This goes back to the very first slide, right? Rule number 1, don't lose money. Rule number 2, don't forget rule number 1. This is your hard-earned money that you're talking about putting in the hands of somebody else, right? You want to do it with confidence, right? And now here's the why, right? Here's why I love doing this, right? This is my family, right? Lend money here, 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 there, right? All the places I lend money, okay? I do a lot of great stuff with my kids, right? I'm a father first and foremost, right? The triggering event that got me into trading was having kids. The stress was more than what I wanted to deal with, right? I didn't like coming home and constantly being pissed off because I was never happy as a trader. I don't care if I made a shitload of money or then if I lost it, I was really mad, right? But at the end of the day, like you realize money's not enough, right? The other thing that this has allowed me to do is it's allowed me to live a pretty nice lifestyle for the last 10 years, right? And not necessarily am I making the most money. You know, we talked about how many people work for me too, right? And then my wife, right? I've kept small, right? Why? Because that's what I want. And the thing about like real estate in general is that there's so many different ways to make money doing it. It's not a one size fits all. What's right for me is not right for you, right? It's what your goals are, what you want out of it, right? What I wanted out of it was passive income. I wanted time to spend with my kids, and that's what I did, right? And so that's kind of the lifestyle that I built. And this was the vehicle, lending was the vehicle that gave it to me, right? And then as a side note, I get to pay my kids for every picture on this slide.
They're models.
Thank you. I'm gonna open it up for question and answers. You guys can fire away, ask me anything. I'm gonna put this is my business card. This is my cell phone, right? And I will say this, as a private lender, right? When you call me, you get me, right? So if y'all want to send me a text, send me an email, I'm happy to reach out and happy to talk to y'all. But that's it. Like I said, I don't have a website.
Real quick, before we open up Q&A, we'll do two things. Number one, I want to respect your time. It's just about 8 o'clock. If you gotta leave, we understand. Go be with your family. Number two, can we thank John and make some noise? Of it. I know we all got a taste, and this is just a taste. If you were curious, if you want more information, if you want to understand this world, there's his information. Reach out to him. Like he says, he does answer the damn phone. He will text you back. He will talk to you. Everybody in here that's dealt with him before knows he gets pretty hands-on. So
It's more the other way around. Like usually when I'm texting them, like that's when they're like, oh, boy, what you want?
But,
I'm like, I don't want to.
if I can tie it all in, number one, I heard a couple people ask questions, and they started the question with this. This is gonna sound dumb, or this, that, and the other. Man, I'm gonna go ahead and say it. Stop doing that shit. And well, at least in this building, right? We honor questions. We love questions. We want you to stay curious, like a kid, like a child. When you stop asking questions and you stop being curious, you stop learning, and that's a horrible shit to do. And when somebody else starts asking questions, if you judge them and look at them funny, you're the one with the fucking problem. So I want that to open up to say, if you do have a question,
Ask away.
ask the damn
Please do.
question.
Yeah.
I have a question. So you mentioned Quest a lot, and I've never heard of that. So they have these functions like monthly or?
They do. So it's a Quest Trust Company. They're located, they're technically off of Park Row. It's like I-10 and I don't know, Highway 6 area, but they are a self-directed custodial company. They will actually, far better than I can ever explain to you, how to open up account, how to transfer the money, do different things like that. I've done it with them, right? They're super easy to work with, right? And they will also put on classes and things like that where they'll actually educate you on like prohibitive transactions and things like that. Now, they will not tell you what a good deal is or what a bad deal is. All they will do is put you in a room with other people that are doing deals, and you still have to do your due diligence. But when it goes to closing, right, you have to follow the paperwork, because I promise you, even if there's a typo in that, like, they will kick it back and you're gonna have to fix it, right? That's the only thing that they do from a compliance standpoint, because what they're really trying to do is keep you compliant with the IRS. You don't want to make a misstep with your retirement account with a prohibitive transaction of who you're loaning money to, because then you get the IRS on you, and we all know they're hiring 87,000 new agents. Right, that's, yeah.
Do you do international deals like vacation rentals and all that?
No, I will do vacation rentals. Okay, I will do vacation rentals. I'll do them if somebody wants to pick it up, right? And even if they want to hold it. So like I'll do like temp to perm type stuff where I'll convert it into a longer term, like 5-year loan. Yeah, I don't, but it's gotta be here. I don't have the money to go all over, and 2, I don't want to go all over, right? I want to go, and I still want to put my eyes on the property, right? And I walk properties with these guys, right? I still do it, right? I still get a kick out of it.
Your properties are all like within areas that you can put your eyes on.
Yeah.
Okay.
Yep, absolutely. Yeah. I have. So when it comes to notes receivable, so you can do all kinds of things in notes, right? My wife suffers from shiny object syndrome. And I suffer from being too good of a husband.
It's a thing.
So I bought, let's do non-performing notes. It's like right after 2013, 14, stuff like that, And I ended up with this note portfolio, and it was all over the country. And it was a real pain in the ass, I'm not gonna lie. And I didn't particularly care for it. I worked my way out of those deals. I learned a lot in regards to how to get properties out of bankruptcy, different things like that. But as far as like handling assets from that far of a distance, I don't particularly care for it. That's personal. Some people, they don't have problems with it. Anyone else?
Private money and hard money, what's the difference? If there is.
Not really. Private money is, well, see, on the private money spectrum, you can do a lot of different things, right? So if we go all the way back. Okay, so these are all different ways you can be the bank as a private lender, right? The hard money is really, that's more what they call the institutions, but as a private lender, right? I mean, technically, they're non-bank financing. They could be classified as the same thing as well. But so any one of these, and I've done this one, this one, this one, this one, this one, and I borrow on collateral. I don't rent that collateral, right? So, but these are all different ways that I have done deals and structured them just as a private individual, right? As an entity, really. Anyone else?
Second question, would you ever land on with somebody using maybe private money or the hard money? Does that make sense?
Yes, they would have to be. The answer is yes, I would. I don't actually have a problem if somebody wants to be a second lien holder behind me, okay? But they're a second lien holder, okay? That's what they are. Now, if you want to get into the merits of gap funding, I'm happy to have that conversation. And I'm going to give you the same advice I gave another guy if you want to do it, right? Cut me a check for half, call it a victory. But honestly, the thing about the gap funding is I can't really say that because what's acceptable for your risk is not acceptable for my risk, right? I don't want to take that risk, right? I'm comfortable with the, excuse me. I'm comfortable with my loan to value. And the problem I have when you're a gap funder is that, first of all, gap funding, that's what they call the gap between what you, the amount of money you have to come out of pocket. And different people do different things with that. Some people might cover interest payments and some people might cover part of the construction cost to get the project off the ground until the hard money lender comes in. My problem with that is what's your true loan to value, right? How are you doling out that money to begin with, right? Because if you give it to them up front, where are you on the overall project cost, right? If I'm loaning money at 75 cents on the dollar, right? And you're bringing in that difference, well, where are you? Are you up to 85, right? Are you up to 90, right? Let's say you're at 90 cents on the dollar. Let's say you're at 85 cents on the dollar. How much does it cost to close a transaction? How much are you going to lose right off the top of the sales price? 6%? Are you an agent? Maybe you can save 3%, but you still got other fees. There's 5% right there, right? So you're at risk of being underwater on that loan in a very short period of time, such that if anything goes wrong on the pricing side, say the Fed raises interest rates 2 points in 6 months or something like that, and now values are coming down, right? Are you going to be able to get out and get all your money back? And how many of those deals can go that slim before you get caught? And are you deep enough, right, to handle it? And how much are you making? What kind of return are you making to cover those types of losses, right? And those are all serious questions. And that's why I don't do it. Now, if somebody else wants to do it, I don't care, right? It's kind of like you lead a horse to water, you can't make him drink, right? You know? Another saying I have is like when you talk about somebody's like financial position, right? Well, you don't put them on that cliff, right? But if it's me or them, right? I know that sounds bad, but that's when I'm getting paid, but this is my livelihood, right? I'm not really like that with the borrowers that I deal with most often, right? Most of the borrowers I deal with, I have a great relationship with, and I like to actually see them succeed, right? Because the better they do, the better I do, right? I get excited. I mean, look, you're never going to get an HGTV show about being a lender, right? It's not sexy. It's actually boring, right? I mean, like what are you gonna do? Ooh, look at this piece of paper. You know, like nobody wants to see that. But some of the work that the ballroom is really cool, right? And so, you know, I'll even find myself, you know, Ralph and Renee, they've done some fantastic job where I'm like, oh, look at this deal, look at what they did, right?
Freaking awesome.
You know, I'm proud of the work they did, and I didn't even do it. You know? So it really, you know, so I want to give the bad impression that I just like, you know, but when push comes to shove, like, you know, you're still in business and you still have to protect your capital.
If you look at a deal that might need gap funding, something like that, it could very well be a good deal. The chances of it being a good deal are slim to none. For a couple of reasons. One, either the deal isn't good enough, or maybe it's not the right time for you to be jumping into that type of situation. Because when you take on that gap funding, your risk is gonna go through the roof, like you're probably over leveraged.
Well, yeah, exactly. You're over leveraged, right? That's really what it comes down to. So now, and I'll give you an example of where it might come in, where it might start to come back. Because a lot of people pulled out. They got their ass handed to them, frankly. I mean, they just had. I loan 75% value on hard money. And I got new people coming in, I'm putting them at 70, right? Why? It's a changing market environment, right? If it's somebody I don't know, I'm reducing my risk right off the top, right? So if I'm at 70 cents on the dollar, that might give somebody room to come in and provide that little bit extra money, right? And if they do bring that in, I don't care. But they're in the back, right? And that's all I do care about.
I have a question. So if I come to you as like, I want to borrow money, the reserves is going to depend on the amount of loan I need. Basically.
More or less, yes.
Okay.
Yeah.
Okay. And what are the, I guess, the pros of using you versus a bank? Because the bank's going to check your credit, but my credit can still be kind of off and I can come to you if I show you everything.
Yeah, I'm gonna pull your credit too,
Yeah.
right? But whereas banks just have hard lines where they can't do a certain, they can't go below or they can't
Right,
do
they
certain
have to-
things, right? I can look at it and I kind of use some reasonableness, right? Because it's, you know, again, credit is a cycle, and where are you in that cycle? Because, you know, something bad could happen that, you know, my wife, like, she's probably gonna kill me for saying this, but well, she got all mad because like she was turning on and off the utilities, and one of the bills, like it was in her name, but we called, we said, hey, we haven't got a bill, whatever. No, we got no bills in your name, we got nothing, you know, whatever, right? Well, it got put into some other sub account of some other property, we never got it, right? It's like a $50 bill, right? Goes to collections, dings her credit, right? She's still battling that shit, and it's been like over a year, right? Trying to get her credit to go back up over something like just ridiculous, right? So, you know, you have things like that, but then you have other people who have other things in their lives that come up, right? Well, number one is divorce, right? I mean, that just wrecks everybody's credit, right? But something, if it happened in the past, right? Sometimes some of that stuff takes a long time to work its way out, right? And so it's really understanding where you are in that cycle. If you're on the way up, I don't have a problem with it. If you're on the way down, we're not going to do business.
You look at when it comes to banks, like large institutions, you have all these different entities that are buying the loans on the way up, right? So you have an underwriting, like these stipulations that have to be met in order for that loan to be sold. When you're dealing with private money, he's the dude that's
Yeah.
underwriting the deal. Or if
Exactly.
you're dealing with like a small local bank,
Yeah,
the vice president is the guy in the freaking building who's doing a lot of the underwriting. So if you develop relationships with guys like him or like small local banks, you got a much better chance of getting some things that may be in the gray area pushed through because they're being underwritten by a dude who wants a relationship with you locally. Wells Fargo's like, hell no, we're done. We gotta package all these loans and sell them to this entity at these type of percentage, and they're gonna double
or
check
bank
everything.
examiners.
The
They're always talking
parameters
about
are
bank
like
examiners. Oh, the
hard
examiners.
lines. And if you're trying to sell a multi-million-dollar, billion-dollar package to a back-end investor, and the numbers aren't met, they're, no, we don't want to buy that fund. And now what? You're left holding the bag if you wanted to unload. So the banks are like, no, we can't play with it.
The biggest benefit on hard money, honestly, is the speed, right? That's the biggest benefit. If you have a good relationship with a private lender, right, then they can work, I'll work in the gray areas on deals based on the relationship, right? Because that's why they build relationships, right? Like it's the lending is still a relationship business, right? And so that's really where the true benefit comes in, right? I'll do top down. Yeah, I said it earlier. I do a top down approach to due diligence on the borrower, meaning I kind of do it like one time. If we're doing, and then we just deal after deal after deal. So if we're doing a lot of deals, right? I'm gauging your credit worthiness at that point in time by your payment history. Because if I've got, one deal out to you and you're missing payments, you think I'm gonna do a second, right? Well, what if I got 5 deals out to you and you bring me a 6th, right? And I'm like, well, can you handle this, right? Well, what's your payment history? If your payment history is you're paying on the first like clockwork, right? And some people pay on the first, some people pay because loans, you got 10 days to pay, right? It's kind of like a legal, like whatever. Some people, they set it up on the 9th every day, right? I know they do. That's fine. They're consistent, right? They're consistent. So I'm looking at something like that as a means of, can you still handle the next deal, right? But if somebody's got 5 deals out, this one's a couple days late, this one's a little late, the next month, now 3 are late, hey, got another deal. No, you don't. You better wholesale that, pay your loan.
Quickness brought a pretty wild order to us. Overall, I think on our side, we're pretty much ready to go, other than like
Yeah, title slowed us down, but yeah, he dropped a deal in my lap literally on a Thursday and said we need to close on Monday. Now it's headed out of town, right? And yeah, so we were in when I saw the title report, I held off on ordering the loan docs. I was like, oh no.
We're getting it work. We had to stop before closure.
Yeah, well, that was, you all did that. I didn't, I had no
no
part in that, but I was gonna put myself in a position to fund this deal on Monday. Just based on, I knew enough and kind of some of the stars aligned a little bit that, we could get some things worked out, but I was putting myself in a position to do it. Right.
Y'all are about to, when we video this thing, you're gonna see probably one of the craziest hoarder properties you've ever seen. There's a village in the backyard of people living in
It's
trash.
insane.
And it's pretty wild, man. But what was the name you said out there?
Yeah,
Brianna?
Bree. Yeah, Bree. Yeah,
She's like, oh.
yeah, I know. She's like,
Where is it?
I think people are living in the back and doing drugs.
No, I'm walking through the house and they're like, oh, nobody's here. My grandma passed away, whatever. And this guy creeps out of her room. And I'm like, what the hell?
Yeah.
And she goes, oh, that's E.T. I'm like,
E.T.
and I'm like, why is he looks like E.T. I'm like, yeah, he does.
There. So
it freaked me the hell out.
because we have a little bit more time, I said like the appraiser, like so I went ahead and say go out there, right? So we was gonna go out there earlier. I said no, you got time, right? He was gonna go on the weekend, right? So he just decided to go today, right? He's just gonna knock it out. He called me up. He said, man, I've seen a lot of crazy houses. He's like, this one is the craziest I've seen in a long time, right? He said, I walked up and like there's so much junk everywhere that like he's like I didn't even notice that there was literally somebody standing there until they moved towards me. It freaked me out.
There's cars, there's
Tires.
motorcycles, there's like I'm gonna try to buy all of them in the house. Like I'm gonna get those in somehow. But in the backyard, it's
Shantytown.
there's little shacks made out of like random shit people live in there.
Yeah,
So we're gonna
it's crazy. Yeah, yeah.
it's gonna cost a good.
Where is it at?
$12,000 just to junk it out.
I don't know. It's like South Houston. Yeah.
Yeah.
It's I got pictures. I don't know if you can.
Yeah, I got pictures.
It's crazy.
Yeah, what I would say is just wrapping it up, in the future, like he's wide open for conversation. You got some great investors, you got Galveston deals. These people can turn some of the wildest crap I've ever seen into like amazing. It's ridiculous the work they can do. So there's a lot of people in here that can help on things. And with our deals, like I invite people, I get online and say he wants to go check out these deals. We can walk them together. We can look at numbers. One of the other things I like is man, one of the most powerful things you can do is go film
Like, come with me and we'll film it together. You'll film it like you're my business partner. We're walking this thing. And when people start seeing you in this world of investment, they're like, well, what do you do? And then they start asking questions. It might be the way you find your next deal. You never know. So, and we're always open to this type of thing. I love that type of stuff. Cool.
Yeah.
We good?
We good.
Let's go. Thank you, John.